Why were mortgage-backed securities a Great Recession trigger? Imagine a world where a single financial product could connect millions of homeowners to the global economy. That's what mortgage-backed securities did, but it also created a big problem. These securities were created by bundling thousands of home loans into one package that investors could buy. Many of these loans were risky, especially subprime mortgages given to borrowers with poor credit or unstable income. Lenders issued these risky loans because they could sell them off as mortgage-backed securities, passing the risk to investors. These securities were often rated highly by credit agencies, making them seem safe even when many underlying loans were not. This gave investors confidence to buy large amounts of these securities, thinking they were low risk. But the complexity of these products was a big issue. They were often combined with other risky investments like collateralized debt obligations and credit default swaps. These complicated products spread mortgage risk across many financial institutions, many of which did not fully understand what they owned. Banks borrowed huge sums of money to buy these securities, relying on short-term loans to fund long-term investments. This high leverage meant that if the value of mortgage-backed securities fell, banks could face huge losses very quickly. When housing prices stopped rising and started falling, many homeowners with risky loans defaulted. This caused the value of mortgage-backed securities to collapse, leading to massive losses for banks and investors. As losses mounted, banks tried to sell these securities, but the market for them dried up. This lack of buyers caused a credit crunch, making it difficult for banks to lend money. Because many financial institutions were interconnected, the problem spread rapidly, threatening the entire financial system. Oversight was weak, and regulators did not fully grasp how risky these securities had become. Policies encouraging homeownership and deregulation also pushed lenders to take more risks. In the end, mortgage-backed securities turned out to be a major trigger for the Great Recession. They linked the housing market crash to the global financial system, spreading the crisis for beyond just housing. This episode shows how financial innovations meant to spread risk can sometimes concentrate it instead, especially when risks are hidden or misunderstood. It highlights the importance of transparency, regulation, and careful risk management in complex financial markets.